Welcome to TheoTrade. This is Don Kaufman, March 27th, 2020, and you are watching the TheoTrade Weekend Update. Another week and more volatility inside of the broader marketplace, but this time, people, it's to the upside. I mean, the big question, I'm getting a lot of emails, a lot of questions really in the chat room. Is that it? Do we see the bottom over there? Sunshine and rainbows, or there's going to be more sell-side activity ahead? I'm just going to cut to the chase and say it. Listen, people, if you're looking for volatility, you're going to get it. And in this marketplace, we are far from seeing that sell-side activity completely abate. The volatility says it, the bonds say it. In fact, I'm going to detail that in just a few minutes when we look at a couple of charts and a few trade ideas. But let's get really down to some areas that don't necessarily involve charts and trade ideas. One of the first things that I want to talk about, of course, is the Fed and maybe then the bailout plan. So you've got both effectively going on. The Fed, which again, I'll discuss here momentarily as well inside of the charts and trades, the Fed just went on an all-out buying spree of approximately $500 billion inside of the last week of trade. It has impacted the bond markets forever. In fact, it has actually changed the bond markets, which again, I'm going to detail here in a moment, so bear with me on that particular front. On the other side of things, we actually have this bailout bill with absolutely unequivocally no clarity whatsoever to the future. And that's one of the points I want to make when I make that comment that we're going to see continued sell-side activity. There's some reasons for it. Yes, we can look at some very technical reasons because of volatility and because of where bonds are trading or because where the VVIX is trading. And I'll get to all of those reasons in a moment. But net, it has to do with clarity really to the future of the economy. So, I can only really draw comparisons back to 2008, which there was a bailout bill of about $900 billion. It took a couple of weeks to pass, and there was just turmoil in the midst of that being passed. It was hideous in October of 2008. What we're seeing right now is like the fast forward, just high-speed version of it. The Fed is full, pedal to the metal, accelerator into ultimately quantitative easing. They're buying everything they can get their hands on. Then if you look at the bailout bill, that's it, $2 trillion. You realize there's probably going to have to be multiple bailout bills. All of this is being done, people, with absolutely zero clarity to what this economy is going to look like on the other side of what can only be designed, in full scope. And by design, this is now an economic disaster. And I call it by design because we shut it down. We effectively shut ourselves down. It's by design at this point. Again, we are now moving into areas of bailouts without actually seeing ultimately what the damage is. The only thing, and I guess the analogy I can give you for this one is you just took a patient in. Sorry for the analogy in this front. You took a patient in, you have absolutely no idea what the problem is with them, but you're putting tourniquets on arms, legs, fingers, and you don't even know what's cut off yet at this point. And it leads us to believe without forward clarity, that we're going to see sell-side activity simply because there's uncertainty on all fronts. And it literally is all fronts over here. You got to recognize that we're going to see industries completely knocked out of the box in this one. And you're going to see bankruptcies. And that's one area that people just haven't necessarily succumbed to yet, is that we're going to see all out, companies hemorrhaging cash right now. One of the great, again, analogies for this one would have to be none other than a firm that everybody's familiar with, which happens to be Cheesecake Factory. If you want to look at it, it's under symbol cake. And I was telling the story a little bit earlier in the week, but use this as a litmus test for just a moment, and that's this. Cheesecake Factory, they're not paying their rent. Everybody's familiar with this company. They're not going to pay April rent. They don't have the cash flow to do so. Again, I believe that is just, displaying more effectively to come. So with that, it's not going to be all sunshine and rainbows. We have no idea what we're about to be headed into economically. We do know that New York is effectively shut down. Chicago is effectively shut down. These are the financial hubs, of really the entire world, completely and totally shut down. With that, again, I know that's not an uplifting thought. Let's jump into it. Let's look at a couple of charts, a couple of trade ideas. We're actually going to break down also, a look very detailed at the SPX. Volatility is everywhere, and yet the marketplace is still doing a horrific job of pricing forward future risk, which again, enables us to say it's far from over. Let's get to it. A couple of charts, a couple of trade ideas. To the charts and trades we go. So as we're finding out into, well, this Friday afternoon's cash close, it is not all sunshine and rainbows. In fact, there was some huge sell-side activity. Take a look specifically inside of the S&Ps here. Well, the last 30 minutes of trade saw a drop from roughly 2,600 right back down to the 2520 kind of handle. Yeah, what's 80 points amongst friends? Nevertheless, let's get right down to it here. Listen, week over week, one of the first things I want to start with is the SPX, and specific to the SPX, we're actually going to look at week over week. And obviously, in this past week of trade, there was an absolute ripping rally to the upside. And again, here is effectively Monday. Throughout the course of the week, we exploded back to the upside, giving it back, but mildly giving it back today. But as I'll point out time and again, and you don't have to look too far to find this kind of data, listen, these rallies, this is what we term the hallmark of volatility. You know, if there was certain things that had to be checked off on a list, a wicked rip your face off rally was part of one. And I thought it was really ironic, and I was talking about this specifically in the Wednesday night video. I thought it was kind of ironic. They were like, yeah, look at the Dow, some of the greatest point moves to the upside since the, wait for it, 1933. Wait a second. That was during the most hideous depression effectively in the United States history. And you're like, yeah, but so it's okay because it's a rally. In fact, people went as far to actually pull out the statistic that it's a new bull market because the rally specific to the Dow, and I'll move away over to the Dow for a second, and we'll actually pull up a year-to-date percentage. The Dow was actually down approximately 37%, and it rallied, and it rallied enough to actually be called the new bull market. I would push most of that aside right now. All right, a couple of points that I want to make in this weekend's update, and then we're actually going to look at some really detailed charts and a couple of trade ideas. Employment data, which came out, of course, earlier this week. It was, again, initial jobless claims, neither here nor there. Nobody's paid attention to initial jobless claims in years, not since the financial crisis, but okay, it points to a very grim economy. Now, we're expecting more employment data. In fact, the employment quote-unquote situation is coming out next week. In fact, if we cruise over here under Market Watch, under Calendar on Thinkorswim, and just take a quick glance, it's, all right, what you look at is the first Friday of the month. So next Friday, we're expecting what we term the employment situation. And that would actually portray the employment situation ultimately for, okay, the previous month, which effectively is March. And I'm going to go ahead and throw this out here right now. Maybe we get this number. I would say odds are 50-50. One of the things they did in the playbook from '08 is they actually started pulling some of the data away from us. And I suggest that they might do the same here. I'm just throwing that out there for your consumption, okay? Because one of the things I just mentioned a moment ago when I was doing the video portion, there's just zero clarity right now, zero. And that's the way pretty much the government might want it for the time being, keep you in the dark, right? I could go a little deeper than that, but I think you guys understand exactly what I'm saying, which is going to perpetuate more volatility in the near term because we just don't have any data points. And even if we had data points, they're initial, okay? The damage that is being done right now with effectively everything in this country closed. Yeah, some of us are working from home and so forth and like maybe less impacted, but we're all impacted to many, many degrees. Nevertheless, the damage, okay, that is not going to be fully recognized. Let's just put a number to it, 6 to 8 months out. There's going to be a huge lag time. So the point that I was also making, okay, is that the Fed, they've just gone all in. And it's the next point on my list over here. The Fed went all in, okay? They did a $500 billion buying spree inside of a week. And this is the point to which we're going to bring up the bonds a little bit. Again, I'll come back to the S&Ps and I'll come back to the broader market, but this is really, really important stuff right now, okay? Really important stuff because it's the bond market that has been such a great indication for us. Okay, the bond market was exploding higher as the entire situation unfolded. In fact, it's the bond market. It's one of the reasons that I got all bearish all the way back in like, mid-February, when again, this was all just starting, is the bond market absolutely terrified me. And then all of a sudden, over the last couple of trading sessions, and again, great point to be made here, the bond market, it's nowhere to be found. There's 1, 2, 3, 4, 5 trading sessions inside the most incredibly tight range. When's the last time you saw a range this tight inside of the bonds? When was it? Okay, you got to come back to what? Back to this neighborhood here. Even this neighborhood back here, which was in, February, that had more of a range. I mean, you got to go back a really substantial time to try to find a range as minuscule as we've actually seen in the bond market over the last 5 trading sessions, what makes absolutely unequivocally no sense, right? Well, let me tell you something, okay? My 3 points here. Fed goes on an all-out, buying spree. U.S. debt gone negative, and the bonds are trading barely. All 3 of these points, okay, relate to exactly what I'm showing you right here. First of all, the Fed goes all in. When I say they're going on a buying spree, they're buying everything that isn't nailed down. They're going to buy corporate bonds. They're going to buy treasuries. Okay. In fact, they bought so much they actually shoved yield negative at one point. So this is actually the Treasury site. Okay. It's the U.S. Department of Treasury. Oh, it's a very exciting website. All I'm looking at here. Okay, all I'm looking at here on this particular site, this is like a 1 month, a 2 month, a 3 month. It's debt, and it's debt listed by every single day. But this is specifically yesterday. But earlier this week, what I'm showing you here is very short-term paper went negative. It went to like 0.01. Okay, we actually had NERP, negative interest rate, okay, here in the United States, which is absolutely shocking. Which at the exact same time that was going on, unfortunately, it correlated to the bonds. They're dead. I was talking about this again quite a bit in TheoTrade and in the chat room here, but the bonds are dead. And I'm not sure exactly if we can trust them, when we can trust them, how we can trust them. When I say the bonds are dead, okay, I'm not relating the fact that they had very limited range, which they absolutely did. I'm relating to the fact that I don't think a lot of people are catching this just yet. They're dead. There's no volume. Now, this is welcome to Japan. This is actually the way that Japan went, is when they're the Japanese version, which is Bank of Japan. When Bank of Japan went on an all-out buying spree, which they've done now multiple times. They've done multiple layers of QE, and I believe that we're actually following their playbook to a degree. Okay, but what it did is it seized up their bond market, which is really their notes, like their 10-year. There was actually articles months back that the Japanese 10-year stopped trading. Like literally no one traded it in an entire session because there was no one really to trade with. It was all the Bank of Japan. And at the same time, okay, I find it unusual, the same time that our Fed goes on an all-out buying spree, the volume inside of the futures contracts goes to nil. Now, there's an important point to be made here. The Fed isn't trading the forward/ZB. They're not necessarily in the futures market. The Fed is actually trading, the bonds themselves, right? They're in the cash marketplace. But it's interesting to see, again, in the ZN as well. Look at the volume. Okay, when we're rocking, we should be doing 3 million contracts today. You want to know what those notes traded today? The notes, one of the most volatile products lately? About 1 million contracts. It's dead. How dead? Okay. Now I'm comparing this to the notes for just a second because again, I want to kind of delineate my point over here because it is a big one. It is a very big one because so many people trade bonds, trust bonds, have looked at bonds, and I'm telling you right now, we have to rethink how we actually look at bonds. If you take a look at the data point that I'm about to draw across your screen, okay, the only time that we've seen volume this light, the middle of summer, July, maybe even August. August had actually bigger volume over here. You got to go back to some of the most dead times in the marketplace to find volume this light inside of the bonds and notes. Bottom line, right now, the Fed, they just destroyed the bond market. Maybe it's temporary, maybe it's not. I can't tell you that. But nevertheless, they're trying to squash the volatility, it appears, out of the bond market. I think very few people are going to catch this until it's ultimately too late. What am I saying to you? In the near term, I don't care that the bonds are up. It's not good for the financials. The financials are going to take the brunt of that hit. Nevertheless, I don't think the bond market, it's off the table. I don't think we're going to be looking at it for quite some time. I'll keep you updated on that front. Next, the VIX and the VVIX, they scream sustained insanity. That's one of the things I started with, sunshine and rainbows. No, there's more selling ahead. Okay, the VIX points to it. And if you guys are unfamiliar with the VIX, get familiar with the VIX. The VIX, though, tends to be, as I've said this 100 different times, this is like my predecessor's indicator. But so many people look at the VIX, so all right, I'm amused, I'll bring it up. We're actually going to bring it up here for the next, or I should say the last 15 years, and I'll bring it up in a weekly. There's only one point that I really want to make with this when I bring up the VIX for this period of time, okay, where we're currently at, which is right there, okay? It's sustained, and it's sustained for a period, okay, even greater than you saw back in 2008. And when I say sustained, back in 2008, and I'll give you a quick synopsis on this. Back in 2008, what you were getting inside of the volatility contract is you were getting these spikes and pullback. And it would spike and it would pull back. And it would actually pull back to the 40. It would pull back to 45. It would pull back to 50. You see that here? No, you do not. Okay. I mean, for the most part, all you're getting over here, and there's a couple misticks in there. Ease up. There's a mistick in there. But all you're getting in here, okay, is sustained volatility. And that ain't a good sign. And if you don't believe necessarily the VIX, I have a tendency to look at the VVIX. The VVIX is the volatility of the volatility index. It's never been sustained like this before. Now, the VVIX has not been tracked, okay, as long as some of the other products on the screen. But if you look back at the VVIX, okay, it would only go back to really March of about 2012. Nevertheless, you are in uncharted territory over here because effectively you are above 110 for 1, 2, 3, 4. We're now in our fifth week above 110. Do you see that at any other time? Okay, sustained above this, not a drop below, not even a hint of falling. Okay, the point that I'm making with the VVIX, it is sustained. In fact, okay, this is indicative of professional traders buying volatility. And clearly, they're still on the bid right now because we're at a 168 VVIX. All right, next point I want to make over here, and I believe this also probably relates back to the Fed. Okay, there's very fragile liquidity. Okay, volume is still not there in the overall marketplace. This is alarming on a bunch of different notes, but number one thing that I tend to look for, okay, in a marketplace, like if people are like, oh, they're going to throw in the towel. First of all, when I say throw in the towel, I mean capitulate. Capitulate in the marketplace. Did we see a bottom, right? Was this a bottom here in the S&Ps at 2174? Was that it? And I have a really tough time saying, oh, yeah, no. I mean, again, I think we have to not only retest it, okay, again, there's not only zero clarity, but the volume, it's just not there for me. It's not even close to there. I mean, volumes are sustained. They're a little bit high. But when I say that volume isn't there, there's a lot of different things you can look at in terms of volume. But I'm going to show you one other really, really bothersome thing. And I think very, very few people look at this. And again, I'm going off the beaten path a little bit. I was talking about this in the TheoTrade chat today. But overall contract size, this is yesterday. This is for Thursday, right? Overall contract size inside of options. This is the OCC, the Option Clearing Corp, open interest and volume. We only did 26 million contracts on Thursday. And it was a huge up move. You know that the March average is 31 million, okay? But the 2020 average is 28 million. We're not even doing average, okay? And we're in the middle of an outright crash and rally. We're not even doing average volume. Something's broken. Something's wrong right now. And wrong, I don't know. There's liquidity seizures possibly out there. There's so much going on that we're probably not aware of. But I can tell you, okay, without a doubt, that the VVIX points to something's wrong, okay? The fragile nature of liquidity points to something's wrong. The volume being low in the option trade points to something being wrong. The wide bid offer spreads that you're seeing inside of stuff like the spiders, okay, you're like, oh, that's just a function of the marketplace and it's crazy out there. Yeah, but it still points to something isn't right now, okay? I think we have liquidity issues through and through. Okay, don't take that as a reason you're like, oh, I'm scared. Oh, hold me. Don't take that as a reason not to trade. And there's still ample opportunities. All you have to do is you have to concentrate. You have to concentrate what you're doing into a handful of products. Trade the Apples, trade the Amazons, okay? Trade the Microsofts, stick with the spiders. Get away from volatility products. They're going to be the death of you. I've answered so many emails about, can you look at the UVXY? The answer is absolutely unequivocally no. You want to lose money? It's a great way to do it. Okay. I don't often say stuff like that, but you have no shot in those particular products. Stick with not just liquidity, massive liquidity, the biggest products on the planet, even stuff like Walmart right now, something ain't right. Okay, the market making firms are moving away. And I want to show you this because I've got a position in here. I can't get out. I can't get out. I got a position in Walmart. Look at the bid offer spreads in some of this. Okay, and those are real. I mean, the market just closed some seconds ago, but those are real. And I'm not saying this to intimidate you. I'm saying this, save your capital for only trading the absolute unequivocal most liquid products out there. And that's something I'm going to detail this next week on TheoTrade is liquidity, liquidity, liquidity. In the midst of the extreme, we all dive into the exact same products. You know, you look at stuff like IWM, which is the Russell. Okay, this is one of the more liquid products out there. Watch, open up option statistics. All right, traded almost 600,000 contracts. Okay, I look at the spiders. All right, it traded almost 6 million contracts. Okay, but then you start looking a little bit off the beaten path. And the point that I was trying to make, you start looking at stuff like Walmart. Okay, it got a little bit of contract size out there. You go any further off the beaten path, okay, and there's just nothing. And it's shocking right now, and it's a little bit alarming. So the market making firms are concentrating all their efforts in a couple of different areas. Fragile liquidity is everywhere. Again, there are liquidity issues to the broader marketplace, and that does not bode well, okay? Because when we start selling off, there's not going to be anybody on the buy side of it. No, don't tell me the Fed's going to buy stocks. Not yet. That's later. Wait for summer for that one. Next, we move to the SPX, the mother of all products. In the SPX, I want to show you something that is just awe-inspiring, okay? First and foremost, in the SPX, last week in the SPX, so I'm going to zoom in, okay? And when I say last week, it's the week we just passed through, right? This, right there. You see that? Okay? That is none other than a $228 okay, expected move. That's $228 higher or lower. What did we do? We actually cracked outside of it, pulled back, and check this out. Okay, coming into today's cash close, we ended up outside of the expected move. All of the volatility that's out there. The edge of the expected move was what? 25.33. 25.33 was the edge of the expected move. Where did we actually close? 25.41. It pulled as hard as it possibly could to come back to the edge. Again, to come back to the edge of the expected move. We missed it by a hair. I highlighted it, but this is one where, all right, we'll give it to the marketplace. But affectionately, we have, well, 10 out of the last 11 weeks have seen moves outside the expected. 10 of the last 11 weeks. And that's counting, of course, this week. But this week, I say, is almost a scratch. Okay, nevertheless, this thing is crazy. Absolutely crazy. But here's the crazier part. Okay, if I go to the SPX right now and I open up the options for 7 days, okay, if I open up the options for 7 days, take a look at the volatility for next week. You're looking at about a 205 expected move. So we just moved more than expected. Okay, what? More than expected 10 out of the last 11 weeks. And these monkeys are actually contracting volatility. Okay, you better be careful. We are still portraying an absolutely dominant volatile marketplace right now. Okay, hey, couple of things here. Fade the bounces. Fade the bounces. What does that mean to you? Well, let me actually show you exactly what it means because we're going to pull up a couple of individual stocks right now. One of the ones I've been looking at and trading quite actively here is Microsoft. Anytime we got a bounce on it, which we did, fade it. What do I have? In-out spread. It's slightly in the money. When you get a bounce on something like what? Okay, Amazon, we got a bounce on Amazon. Good. Fade it. Fade it means take the opposing side. We got a bounce, okay, in Boeing. What did I do? Fade it. Am I going to be right in timing Boeing? No. There's no chance. Boeing just traded, okay, from 89 to 185. Pullback is probably going to be imminent. Nevertheless, fade the bounces when you get them. Okay, but you got to stay with, again, the most liquid products out there. Again, we still believe that the next round of sell-side activity is going to come to a technology theater near you. You got to realize right now, everything's shut down. How do you think advertising is going to look? Have you looked at Google lately? There's a company called Google, okay, that is completely and totally dependent upon one aspect, and that's advertising. Everybody's like, no, listen, everybody's sitting at home. They're online. Yeah, and advertising right now is about to be cut next to nothing. I mean, they already canceled the Olympics for a year, or should I say postponed the Olympics for a year. Okay, think about the advertising dollars that are in play in the month of March. See, in the month of March, if you're a major S&P 500 company, you already had committed your dollars, okay, for your ad revenue spends for March. April? Oh no. No. They're going to cut, okay? Why? Cash flow is not going to be there. Fade the bounces. Take a look at something like Google right now, which is down 18% on a year-to-date basis, okay, and how it might compare to some of the other peers. And I'm telling you right now, they're going to come for technology. And when they come for technology, I'm going to be there, okay? I'm going to be there. Fade those bounces. Now, last but not least, sell premium to get net long stocks. What does that really mean? Sell premium to get net long. I am building and have been building a position in none other than the XLE, okay? I really do. I want to be long energy. Why do I want to be long energy? I don't know. Call me crazy, but at one point it was actually down almost 65%. It's had a little bit of a bounce already, but I'll tell you what, I think we actually may get another bout and actually come under here. We could be down as much as 70%. Oil, it's not looking good right now. $21.66 a barrel. Nevertheless, I'm trying to build a position in here, and to build that position, what am I doing? Okay, I'm selling out of the money options. Check it out. These, okay, there's 0 days left. These little monkeys just expired worthless. I'm selling premium there. Okay, I'm selling premium a week out. I'm selling premium all over the place in energy because I want to build a position in here. Sell premium to be able to get long. Why? Because volatility hasn't been better. So you're getting paid to buy an underlying at a particular price. Again, much more on that in the days and weeks to come. Again, it's not going to be sunshine and rainbows ahead. There's going to be more sell-side activity. How vicious is it going to get? Well, that's up for debate. You don't want to know why? Think about this. Zero clarity. That's going to be the topic of conversation. Zero clarity. We have zero clarity to jobs, zero clarity to advertising, zero clarity to cash flows right now. We have companies that are coming out with earnings. I subject that they're probably going to hold back some of the earnings. Damage is being inflicted every hour that these places are closed. Okay, and what do we have? $2 trillion bailout bill right now that, again, it's going to be a tourniquet, but we don't even know where the bleeding's coming from. Thanks, everybody, for joining us here at TheoTrade for the weekend update. Try, relax, have a good weekend. Bye-bye.